Hi, good morning. My name is Jim Rapond, and this is Seattle Real Estate Chat, and this is our episode 57. Today I'm joined again with Rhonda Porter. Rhonda, would you like to introduce yourself?
Thanks, Jim. I'm Rhonda Porter. I'm a licensed loan officer with Mortgage Master Service Corporation, and I'm the author of The Mortgage Porter.
And I'm a real estate broker with Coldwell Banker Danforth. Today, we're going to be talking about new conforming loan limits. First time since 2006 that those have changed. Rhonda's been all over this and has a great blog post on it. Rhonda, why don't you lead us in with the news?
Sure. Loan limits have been raised for conforming loans across the country, and they've been at 417,000 and still are through the end of this year. For, as Jim mentioned, for the last 9 years. And so the increase is pretty big news. For all counties, the conforming loan limits are 424,100 for a single family unit. And then some counties like King, Pierce, and Snohomish counties have what's called a high balance conforming limit, which means that that you get to have a conforming loan amount at a higher loan amount. And so it's going from 540,500 to 592,250. So that's a pretty big increase for a single family unit. And that'll be effective for loans that are closed and delivered to Fannie Mae or Freddie Mac in 2017.
Okay, and just to back up for just a second, because all of us real estate and mortgage geeks understand conforming loan limits, but why don't you explain the difference between that and what's the next level jumbo and what that means?
Right. Well, so we start off with the base conforming loan limit. So there was a time when we didn't have what's called high balance, and so if you have a loan amount in 2017, effective January 1st next year, and your loan amount is $1 over that conforming loan limit, it may be a jumbo loan unless you're in one of the high balance counties. And then with that base conforming loan limit, which is going to be 424,100, rates are better than even a high balance conforming, but that's your best rate for a conventional type mortgage. And then the next bracket that was created, and I can't remember when high balance came out, but I want to say it was probably around 2006 or whatever, maybe slightly before that. But I should look that up. But high balance conforming is kind of in between a jumbo loan and a conforming loan. So it's also another loan limit that prevents you from being in a jumbo category. Conforming mortgages are typically, and high balance conforming, are easier to underwrite. They're quicker to process because they're going to be sold to Fannie Mae or Freddie Mac, and so you just adhere to their guidelines. When you get into the jumbo market, you're dealing more with, or it's also referred to as a non-conventional mortgage, or non-conforming, excuse me. Then those loans can be, they're scrutinized a little bit more. The rates may be higher. Sometimes the rates are actually lower, just depending on markets. But they're going to have typically a little more stricter guidelines because it's a higher dollar amount. You also typically need to have more down payment for those mortgages as well.
So again, just to reiterate for the newbies out there, we're talking about the limit of the maximum loan amount when we talk about conforming loan limit. Now, conforming loan may or may not have anything to do with the value, right? I mean, it could be something to do with percentage of commercial space in a condo building or other things like that, right?
Certainly. I mean, that goes down to what guidelines are allowed. So you can have well, there's been transactions where we've had clients where they are looking for a condo in a commercial building, and the retail space exceeds in the entire building what a conforming lender would allow. And so then you either need to go to a non-conforming mortgage, which may be, it's a really pretty broad range of definitions, but that might mean that you're going to a lender that does non-Fannie Mae, non-Freddie Mac loans. So conforming typically means Fannie Mae, Freddie Mac. So
right.
Yeah.
And a lot of these loans are, most typically we're talking about single family residential homes or condos, but they also do duplexes, triplexes, and fourplexes, right?
Right. Right. And so, and I didn't
And
really go over that, but like for a duplex in 2017, the loan limit will be 758,200, for a triplex 916,450, and for a fourplex 1,130,950,000. So
so, assuming you can find a fourplex for sale in the general
yeah,
Seattle area because inventory is so low right now, you would be able to get a loan amount of that, plus, of course, whatever you'd be required based on the criteria that you're setting as a lender or that is available to you for loan packages of 10, 20, 50% down, whatever it might be.
right.
Is that the best way to say
Yeah,
that? I
yeah,
just
I
want to make
think
sure that the newbies out there understand that's kind of what's available. And so, can you give me I know rates have been inching up a little, but can you give me an idea of someone if they got that maximum loan amount and they were putting a 20% down or 10% down, their payments? Have you worked any of that kind
I
of
haven't
numbers
worked
out?
that out. No, oh, no, I didn't.
No,
I
that's
didn't.
okay. That's okay. I mean, little
Yeah,
teaser. Call Rhonda to find that out
right,
if you
right.
want to
Thank
know.
you.
But they have been ticking up a little bit, and that's usually a sign that you're going to see over time a gradual increase. So getting in sooner rather than waiting for later. All those people who are waiting, thinking, "Oh well, interest rates are low; they'll always be low." Well, they're not always low, and
Right.
it's people are saying that there's a high probability that they will rise over time now as the economy starts to kick into higher gear, assuming something doesn't go wonky in the economy. We just never know about that, but that seems to be the trend, right?
Right, right. And it's rates really started ticking up. A couple things have gone into effect. One of them is we've been anticipating the Fed to increase the Fed funds rate. And while the Fed doesn't directly control mortgage interest rates, they certainly impact it, because they're controlling the rate for what banks will receive funds for. And so as they raise rates, we're going to see mortgage rates increase as well, in a reaction to that. And so it's looking like odds are that the Fed will raise the Fed fund rates next month in December, and so you'll see rates increase just on the assumption or presumption that this is going to happen. In addition to that, too, rates have gone up higher following the election, and which was really it was startling at first because the eve of the election, as we all know, markets were tanking in the off hours following the election results. And I was sure we were going to see rates drop as well. But everything rallied by the time the markets opened, and it wasn't, the data was absorbed as a result of the election. And the stock market, as we know, is booming right now. It has been in record territory with highs, and rates are following that. They are increasing as well. Because when the stock market does really well, people tend to pull money out of bonds and then they invest into stocks. And mortgage rates are based on mortgage-backed securities, which are bonds. And so we're seeing rates trending much higher. And I think you have a graph that I sent you from Freddie Mac.
Yes. Yeah, hang on. Let me pull that up for you. Actually, it's in your next to your blog post here. Share that so that everybody can see it. Here we go. So
Yeah.
in this article, it's directly from Freddie Mac's site. There is this chart. Let me pull. There you go. Go ahead.
So you can see this is rates from the past year, and the blue line is the average rate for the 30-year fixed. And what's been reported as from a survey, this is the prime mortgage market survey, as you can see. This survey is compiled from lenders from across the country and what their current rates are based on their applications. And so these are rates from the week before November 23rd, the week prior. So this data is old. I mean, it's already over a week old, these rates. But it does definitely show you the trend. And so you can see how rates have been climbing off their lows. And that would be for the, not only the 30-year, but also the 15-year. And I believe they also have an arm on that chart as well. I anticipate we're going to continue to see that trend. And historically, rates go up a lot quicker than they come down. So with these higher loan limits, what will they do to our prices in Seattle for homes? Will that drive prices higher? But the one thing I think that's going to counter the higher loan limits is the higher rates.
Yeah, that, and I think there's also a good bit of anticipation that we'll start to see a little bit of an uptick in inflation again as the economy is starting to churn more. And if markets loosen up a little bit, which is sort of anticipated, I think that's what's rallying the stock market a little bit. That then you're going to see, okay, commodities are starting to kick in with higher prices, which then in turn all the energy costs and everything start to add to the cost of goods, adding to inflation. Again, the Fed has to kind of counteract that by raising their rates, and it all kind
Right.
of weaves together a little bit.
Well,
So
inflation is one more thing that'll drive mortgage rates higher as well, because I mean, because they
right.
infuriate the return on bonds. So yeah, it's just I think it's baked in the cake. So,
Yeah. It's been so long since we've even had to say the I word of inflation, but I think its time is right there, and hopefully it doesn't go crazy. If you're old enough like me, you know how that can get, but probably won't. It'll probably be tamped down by just raising the Fed rate to offset it. But yeah. So okay, well that's great. Any other mortgage news you have to share with us?
well, we should have FHA should be releasing their loan limits at any time. My guess is that for the King County area, that it'll follow the conforming loan limits, but we won't know until they have that. Their loan limits vary county by county more than the conforming loan limits, and VA should be following as well. Although VA technically doesn't have a true loan limit for their jumbos, but they do have a loan limit to meet the zero down requirement to be able to use the eligibility. But so I'll be posting that info on my blog at mortgageporter.com once that becomes available. And again, it should be any day.
Great. And have you heard any rumors as to, well, you think maybe a result of the election with the new Trump administration, do you think that there's certain things that might affect Fannie Mae, Freddie Mac, FHA specifically?
Well, the one thing that lenders are wondering about and talking about is what may happen with the CFPB and possibly the SAFE Act and different regulations that have been put into place. It seems that the new administration, is into reducing some of the regulations that have been put upon various industries in the past few years. And there's a lot of things that happen to the mortgage industry that I think have been beneficial, but there's a lot of things as well that haven't really made a lot of sense or have been very constrictive. So it'll be interesting to see what happens and if any change to at this point, will be hiccups. But I think we've gotten used to kind of bumping along, with what we've had to go through these past few years since the meltdown.
Yeah, sure. Yeah. And a lot of the stuff that had to do with the meltdown really had a lot to do with the lack of enforcement of existing regulations. So I know
Exactly.
there's a
Yeah.
strong movement in the Trump agenda to get rid of Dodd-Frank altogether. And that was really a lot of the regulations that came in as to try to safeguard against the big banks failing and all that kind of stuff. But it sounds like it may make sense that they don't throw the baby out with the bathwater and get rid of all of it, but that they keep a few provisions and things that might make sense for safety reasons, and then get rid of the overregulation stuff that was really, like I said, kind of already baked into the pie of all of the regulations that existed back then, but then actually enforce them. So
Right.
we'll see. I mean, it's all speculative at this point. Any other predictions? We should do a year-end
Oh my gosh.
prediction thing,
Yeah,
but
let's do a follow prediction one or something.
okay, all right.
I think we're going to see rates continue to rise. I think we'll see them. Boy, like the last few years, I've said I thought that we'd be 5% by the end of the year. I think we'll be around 4.5% by the end of the year for a 30-year fixed.
So that's
we'll,
roughly a point higher than we are now, or three
oh
quarters
no,
point.
we're already close to. I mean, the rates from 2 weeks ago was 4. So
Okay, half a point more.
yeah, I think we'll be around there, but I think we'll see it like level out around 5-ish is by, I don't know, spring. So
Yeah,
we'll
wow.
see.
And that's significant. That's going to make a difference. So it does make sense for people to get in and buy something as soon as they're able and ready, rather than sit around and wait. No real expectation that prices are going to go down and or that rates are going to go down. So
Right.
I'll make a one or two predictions. They're not good ones, but I wish they were. I was hoping inventory would increase. And there was even some talk among people who said before the election, oh, if Trump wins, half of Seattle's going to move to Canada. Well, that's not. So that part's gone. But we thought, well, maybe things might slow down in the market, and that would create more inventory. But it looks like, because, again, with all of these changes we weren't really expecting to happen, it is a really divided country. Let's face it, the whole blue and red thing. And there's a lot of people in this area that are more liberal, or I should say Democrat, than Republicans, at least on this side of the mountains. And it is a place where people feel comfortable in that environment. So, and you have a whole bunch of people now in Washington, D.C., which was the first and second fastest growing city in the United States for last year on many months, suddenly out of a job. So, with that switchover of lots of new Republicans coming into jobs and lots of Democrats going out of jobs, I'm anticipating that we're going to see kind of an influx of people who are saying, okay, now that I'm out of government, well, why don't I move to Seattle? So we get these influxes usually from weather, sometimes from something like politics, and sometimes from economic reasons, actually a lot from economic reasons. The growth of Amazon and 20 years ago, the growth of Microsoft, and all of that has really made Seattle have leaps and bounds of growth. But we may see a little bit of a bump from people moving in just because of this whole shift in politics that nobody was really anticipating would happen. So that's my little prediction. We'll see. It's not good, though, because what that means is inventory will continue to be very tight.
Right.
If we have more people moving in and the same limited amount of inventory, and it's very low now. It's one of the lowest it's been in since I can remember. That's going to be a problem. Also, I heard that a report, I don't have it here handy, just yesterday, that housing starts, I think it was in Puget Sound Business Journal, that October residential building starts are down significantly for the month of October compared to October a year ago. And it didn't really go into speculating why that was. I'm guessing that maybe it's just there's not that much available vacant land to be building on right now. And that could turn around. These things, the monthly numbers jump up and down a little, so that may not mean anything. But anyway, so great. Well, so let's plan on doing a year-end prediction thing. We did that, I think, last year or year before, right? Hello? Did I lose you, Rhonda?
Right.
Oh my goodness.
Oh, there we go.
Oh, no, you're back.
We both froze, I think.
I could see myself, but I couldn't see you, and all of a sudden. So anyway, so I was saying, why don't we do a year-end one like we did last year or year before?
Sure, I think that'd be great.
Yeah, it's always fun, and we can go back and maybe even pick out some of the fine moments of our that we noticed in our markets of real estate and mortgage over the last year or so. So it's been a while, but we're back, and we'll continue to be back on a regular basis. Thanks so much, everybody. I appreciate you joining us. You can reach Rhonda at where?
Oh, at mortgageporter.com is the easiest way to reach me. Yeah.
Yes, and for me, it's seattle-realestate.com, and you can always call me, and all of that information, contact information is down below, I'm sure. Thanks so much for joining us, and hope to see you next time. Bye, everybody.
Happy holidays, everybody. Thank you. Bye-bye.
Yeah, happy holidays. Bye.